All right. Hello, everybody. Welcome to my channel. This is the show where I talk about stocks that are interesting. So if you find that interesting, please consider liking the video and subscribing to the channel. My name is Michael Duke, and today we're going to be talking about a super interesting company. Uh, really, really a unique company in today's market. They're called Cal-Maine Foods Inc., ticker CAL. As always, this is not a recommendation to buy or sell a stock. Please do your own research. This is purely for information, purely my opinion. As always, on today's video, I'm going to give an overview of the company. We'll take a look at their website, history, and whatnot. I'm going to discuss the investment thesis behind why it may or may not be an interesting company. We'll take a look at the financials. We'll take a look at the valuation. We'll take a look at some of the risk factors with the company. We'll also do our technical analysis of the stock chart, as always, and then conclude with a grade: buy, sell, or hold. All right, let's get into it. Cal-Maine Foods, very simple to understand company. They always say invest in what you understand. Well, this is very simple to understand in the company profile here. Cal-Maine Foods Inc., together with its subsidiaries, engages in the production, grading, packaging, marketing, and distribution of shell eggs, egg products, and prepared foods. The company offers specialty shell eggs, including cage-free, organic, brown, free-range, and pasture-raised, and nutritionally enhanced eggs, as well as conventional eggs under the Eggland's Best, Land O'Lakes, Farmhouse Eggs, Sunup, Sunny Meadow, and 4-grain brand names. It also provides ready-to-eat products such as hard-cooked eggs, egg wraps, protein pancakes, crepes, and wrap-ups, and sells feed, miscellaneous byproducts, and resale products. Eggs. It is a pure play way to gain exposure to eggs, short of speculating on egg futures or the like. So that's super interesting, right? I don't know if you guys remember, but during kind of peak COVID, really, past the lockdown, once money was slushing around, egg prices skyrocketed. I mean, that was a major component of inflation. This was all the talk of the town. Oh, look how expensive eggs are. Look at eggs. So a smart stock investor brain would have you say, well, gosh, how do I profit off of increasing egg prices instead of just paying them at the store? You could buy chickens if you got some land and produce eggs and profit off of lower costs. Maybe you sell a few, whatever, or you can purchase shares of this company, right? So it's pure play egg exposure, which in times of whipsaw inflation like we've seen the last few years, where it's volatile. The last CPI report kind of came back, showed an uptick. Does that flow through to eggs, or rather, are eggs a component of that? Well, not so much. In fact, here's the egg chart. Like I was saying, egg prices were really stable. This chart only goes back 10 years. I don't have the paid plan here. Can go back further. Egg price is fairly stable, running up into the 2022 period where they went from, this is per dozen. Okay, these are the wholesale price, I believe. Okay, so they were, gosh, it's really annoying how I can't. There we go. So they were, 70 cents. Then they went all the way above $5, right? So, 800%, whipsawed right back to 70 cents again before topping out. I mean, you remember this. I mean, just last year, they were $8. And now, really just 2 weeks ago, they hit their lowest point in the last 10 years, less than 20 cents per dozen, according to this data here. So again, if we this is the 10-year chart. Cal-Maine Foods, right? The stock price is clearly correlated. You see the double spike here. It's clearly correlated to the price of the eggs. However, while eggs, like most commodities, are either flat or whipsawing up and back, this stock's been more of a compounder. In fact, it's crushed it over the last, 30 years, up 4,200%. Super interesting company. It's just I just want to give you some insight here. I was just taking a look at this a moment ago. Company founded in 1957. Okay. Then 6 years later, expanded to build world's largest egg farm, Edwards, Mississippi. So right off the bat, this company's been in compounding mode. 6 years. Now we don't know what they were looking like at their founding. Maybe there was serious capital there invested. But by 1963, the world's largest egg farm, so just pure producer, right? No value-added products, probably. But another 6 years later, formation of Cal-Maine Foods. Adams Foods merged with Dairy Fresh Products and Maine Egg Farms to form Cal-Maine Foods. And then each of these subsequent timeline hits and notches is just them compounding by buying something else. Acquired egg operations of Ralston Purina. IPO'd in 1996. Acquired operations of Hudson Brothers, adding 1.2 million layers. It's millions of eggs every day just from that. Acquiring operations to increase production. Acquired the operations of Hillendale Farms, increasing production capacity by 30%. Acquired egg production assets, adding 6 million layers, and it just goes on and on. But what's interesting is everything is eggs. They sold over 1 billion dozen eggs annually. Just eggs, 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 eggs. More acquisitions. Eggs. Eggs. Well, where it gets interesting, made investment in Meadow Creek Foods to focus on hard cooked egg products. So there's an expansion into, another more like value added product, more laying hen acquisitions. Right here, Crepini LLC, establishing a new egg products and prepared foods joint venture. Acquired Echo Lake Foods, adding production and distribution of ready-to-eat egg products and breakfast foods. Okay, so there's another kind of value add product, acquisition or development. Acquired the shell egg products and prepared foods assets of Creighton Brothers for a total purchase price of approximately $128.5 million. So almost 50 million laying hens and 4 billion in sales. So what we've kind of seen here, again, don't read too much into it because this is just, the fluffed up company website, all the highlights. And of course there's, one time here, right? Like right here, there's just like 24 years of a gap. But it does appear to me that in recent years, there has been more of a push to diversify away from eggs because what is great and bad about this stock is because it's such a pure play egg stock and egg company, it becomes a proxy to speculate on the price of eggs. And that flows through to their financials when egg prices shift, of course, and we'll look at the financials in a moment. But if you're a shareholder in this company, let's say you own the majority stake, you're highly exposed to the egg cycle, which is obviously very cyclical and very volatile. Again, $8 all the way to 18 cents. So a company with this scale, they're, presumably doing well no matter what. And in fact, as we look at their balance sheet in a moment, we'll find out why they've been able to, over time, uh, consistently compound. It's because of the way they manage their balance sheet. But if I wake up tomorrow and I'm the CEO of this business, I think one of the first thoughts I probably have is, can we diversify and have, purchase assets that are kind of make our cash flow a little bit more robust, and just ever so slightly take us away, um, not take us away, but compound us in a more smooth fashion away from the egg cycle into more value added products, prepared foods, and whatnot. So it makes all the sense in the world why the management team would want to do something like that. Because, yeah, I mean, again, if you invest in commodity stocks like I do, you're doing so because you think the commodity price is going to spike, or it already has in the underlying stocks that are exposed to that commodity in a good way, where they have operating leverage, haven't moved yet. So diversifying the business perhaps does create a less volatile stock price over time. So I think the thesis on this and why it's interesting right now is pretty simple. If we kind of zoom in a little bit, it is the current price is in a trough compared to the all-time high $115. We're less than $80 now. So we're certainly at the lowest price in the last year. Although egg prices are, pretty much the lowest that they've been over the last 10 years, stock price is still up over that time frame by a significant period. So in other words, it's been historically less risky if you want exposure to egg prices in a way that you can profit from it. It's been historically less risky to just own shares of this company than to, speculate on egg futures, or, be a small scale producer, because this is your competition in a lot of ways. So super interesting. So yeah, the thesis is simple. You want exposure to eggs. You want to, and we're at the bottom of the cycle. As such, the stock is bottoming. Now, why isn't it all the way down here to match the price? Well, because there's been, and we'll look at the financials in a moment, there's been some growth, right? Presumably. And because of their business strategy. But we're still, more than 40%, or roughly 40% off of the all-time high, with eggs at cyclical lows. So of course, you always, if you are going to buy commodity stocks like this, and I'm sure that they would be offended that I'm calling it a commodity stock, but you get what I mean by that. If you want to, if you're going to enter into a position in something like this, common sense in terms of the commodity cycle it's exposed to would tell you that now is a compelling time to at least analyze it. So let's do that. Let's take a look at the financials. All right. We're just going to hop right in to Seeking Alpha here. Okay. So again, we're going back 10 years on the annuals. Okay. So despite the fact that egg prices, for the most part, are fairly stable, they spiked and now they're back down to lows. Revenues have uh, generally trended up over time. There were a few years where they were fairly flat. And of course, May 2026, $2 billion of sales. May 2025, which again is like, recording these prices here, we obviously have a big spike there. So all I'll say there is that there's more of a steady, the revenues have trended up in greater magnitude than the prices have trended up, which means that they're continuing to invest in more capacity. And we saw that on their website. So that looks really good, right? But not a whole lot to glean from that. I think the best thing to do is to take a look at the margins. So again, if we just kind of go to the worst year, which is 2017 here, gross profit of 45 million on $1 billion of sales, so less than 5% profit. Whereas in the trailing 12, they've had 3.5 billion of sales and 1.2 billion of gross profit. So 30 something percent gross margins. Here you see, revenues being 4.2, 4.3 billion and 1.9 of gross profit. So of course, again, these types of stocks, margins are volatile. As the underlying commodity explodes in price, there's an enormous amount of operating leverage and margins boom. And then, that doesn't happen. It happens in the inverse as well in the down cycle. Um, so you see here, in terms of operating income, there isn't much of a trend either. Also very volatile. And there have been, there's several years there where they hardly eked out a profit at all, right? Where they hardly eked out a profit at all. Now, one thing we need to look at is interest and investment income. So when we look at their balance sheet in a moment, you'll see that they don't have any debt, really. Um, so, and they're cash rich. They carry a lot of cash. It's old school business management in terms of the finances. So, higher interest rates have coincided with, just more cash flow to this company. I mean, they made more interest income in the last year than they did gross profit on their operating business in 2017. Pretty interesting, right? And I'm not saying that that's a reason why it's a good stock or whatever. It's just, notable. You also see here, so shares outstanding have been flat. Like they don't really buy back shares. They don't really buy back shares at all. And the dividend. So they pay this dividend, right? Well, you see here, obviously it's a variable dividend. It's not consistent. Some years they haven't paid a dividend at all. And then in 2025, $8.36, which at today's price is, double digit dividend yield. So one thing that's really interesting about this company to me is their dividend policy, and we'll just look at their website. So they have a dividend policy. It's very simple, which I like. Cal-Maine pays a dividend to shareholders on a quarterly basis, computed in accordance with an amount that is equal to 1/3 of quarterly income. So it's completely variable. They pass through exactly 1/3 of the profit when they make it as dividends. And so again, because of all the enormous operating leverage, you very literally, if you own shares in this company, you very literally just purely profit when egg prices are high because their margins skyrocket. Their margins skyrocket from, like lower levels, and it's just a complete pass through. Their dividends scaled. So this isn't one of those dividend stocks that, will pay you the same amount for 4 quarters and then raise it a little bit. And that's kind of what most companies in the United States do that pay dividends. It's just kind of something that they do. But this company doesn't do that. And I like that. Like I like how their dividend policy is very appropriate for the type of business they are. I did a video on Lion Del Basil or whatever, one of these petrochemical producers. And my main criticism of that stock, and it's actually, it did end up cutting the dividend, and it's done well since then. But my main criticism of that stock is they're kind of in a business like this where it's really cyclical. But I don't think it makes sense for businesses that are really cyclical to pay big dividends that they increase every year because again, what their business is exposed to large fluctuations in top line. And so I really like the dividend policy. And furthermore, if egg prices ever spike and you're already owning the shares because you bought them at a cyclical low, again, this is not a recommendation. I'm just saying if you already own the shares of this company at a cyclical low, dividend or egg prices spike, well, you might stand to yield double digit cash flow on your money. and not something you should expect to continue quarter after quarter after quarter, but that's certainly compelling, right? And the payout ratio being, not 33% across the board, that's just due to the fluctuation of periods. So let's take a look at their balance sheet now. Uh, Again, their income statement, the main takeaway there is the dividend policy, I think, and also the fact that the revenue and the gross profits are obviously cyclical like the egg prices, but they're less cyclical. And that is what you achieve from scale, right? So we take a look at their balance sheet. Is well, hold on, before we get into that, let's zoom in a little bit on the income statement. Let's go to the quarterly. So you see here, so from March 2025, again coinciding with this period here when egg prices topped all the way to $8 very momentarily, but still were elevated. You see goes up and up down, right? So this comes all the way to September 2023. So that's roughly this period here. So we're capturing this cycle, which is really insightful. And you do see how their revenues, yeah, it's pure egg exposure. However, what we do see is here in, again, September is when we start. September is when we start. Egg prices are above $1 for all of September. There was a brief period they were below, but largely that quarter is capturing these prices here. And right now, the most recent quarter, egg prices have really been lower. But what we see here is that revenues are higher in the most recent quarter, 667 million versus 459. So despite the cyclicality, they're trending up. It's a really volatile up and down, but it's going up. And that's due to the fact that they continue to acquire more assets. And, prudent management, I'm sure, too. And you see gross profits are more volatile than the revenues, right? Because revenues are just a pass through. Gross profits, there's your operating leverage. So we see here operating income being even more volatile, of course, because SG&A is going to be something that isn't necessarily controllable. So you see how that's somewhat volatile, but not really cyclical compared to the prices. So yeah, it's just pure. You're riding the wave of the egg price at this point, more or less. We know that they've been acquiring more of those value-added products. So I'm not going to do some sort of attribution analysis where I treat out, how much of their business is this versus that. I would urge my viewers, if they're interested in learning that you do an analysis like that yourself. But obviously, we see here we're at a point now where they're barely eking out a profit, as to be expected, given the prices. And then let's just look at the. Oh, yeah, we want to go to the balance sheet now. So, with everything that's happened over the last few years where the prices have been really high, they've captured a lot of cash onto their balance sheet, whereas before they had a couple hundred million, now they have over $1 billion of cash. At least they did in the last annual. Yeah, see, they have over $1 billion of cash equivalents still. So, when I'm looking at cyclical companies, I really want to see that. And again, that's a function of the dividend policy. When you start making money hand over fist and you just raise these stable dividends, that creates, maybe you're not able to retain as much cash. One company I looked at, and this was over a year ago, was Nutrien. Very similar in terms of the cyclicality of that business. They have a stable dividend, but they raise it very, very slowly. And their financials looked a lot like this too, where there was a huge price spike around the same time as the egg prices, and they kept a lot of the cash. And what's really great about that is it creates a war chest of cash ready to deploy, where when the cycle turns again, maybe now you can buy cheap assets that are distressed. So, yeah, I think the main story to just glean from here is, for a business like this, looking at the amount of cash on their balance sheet and how that's trending over time, that's important. Now, we know that they're not going to use, like, if they start breaking even or losing money, they're not going to pay the dividend, right? So that's a really shareholder friendly policy. Ultimately, I think it protects all stakeholders. They're not just frivolously just continuing to return that money to shareholders. They're instead keeping it so they can compound it. And then right here, long term debt. So they don't have any long term debt, haven't since 2018. Okay. They do have other liabilities. Current liabilities 213 million, total liabilities 400 million versus, you know, 1.1, 1.2 rounding up of cash and 235 million of receivables plus inventory. So they're incredibly liquid, just super strong balance sheet, just very well managed. And you see that in terms of the retained earnings. They haven't been there because their dividend policy is just completely flat in terms of how much they pay out. Earnings are retained, right? Unless they're just starting to lose a bunch of money. But again, when they lose money in a given quarter, it's because egg prices are really low. And egg prices don't remain low for long. Low is relative also. So again, you see here $57 of book value per share. So we're not quite trading below book like the other company I did a video on today, Fresh Del Monte Produce. But still a good amount of book value per share. Hold on, I gotta address this real quick. Cash per share, also something that's relevant to look at. $8 of cash for every share. Um, that's not like insanely high. You're not like in the money when you buy the share. So from that point of view, it doesn't really appear, at least just looking at the balance sheet, that we're particularly at this like crazy screaming good valuation. And that just might be because of the market's perceived level of quality here. Again, where we look at their assets, they got 158 million of land, 723 million of buildings, 876 million of machines. So, this is 1.75 billion dollars of assets, like kind of fixed assets, we'll call them, versus a $3.64 billion market cap. So from that standpoint, the shares aren't necessarily cheap. But let's dive deeper into the valuation. Again, over the trailing 12, and using PE ratios is not, I don't think it's something that's very temporary that you want to do, I think, with a stock like this, because again, their earnings are so volatile. Something, in a lot of ways, when a cyclical stock has a higher PE ratio, it's a better deal potentially because the earnings are depressed. And I think what's going on here is egg prices only recently, you see January through March. I don't know what the fiscal year of this company is, but if it's January through March as the first quarter, we've only been in these really trough level of prices for one quarter. So the trailing 12 price earnings is going to look a lot higher than really the true earning power of this business. But very cheap on a trailing basis. And then on a forward basis, again, that's really, I wouldn't even look at some sort of analyst provided forward. If you're going to calculate a forward PE on a stock like this, I would do the legwork on your own too. I'm not going to do it, by the way, right now. I would come up with an estimate of that on your own because, again, the volatility. But by all conventional measures, again, we're assigning a certain forward amount of sales and earnings here that I haven't drilled into really. But by many measures, it is you know definitely cheap. We see here the forward earnings were less than half of the 5-year average. We're at a lower valuation on enterprise value versus sales, both trailing and forward, that we've been over the last 5 years. Normally, we trade around 1 time. The enterprise value versus EBITDA is definitely much lower than it has been. And on a forward basis, that's also really low. And I think that, again, I don't know if we have enough time to really drill into that today, but the forward numbers certainly look strong by looking at all this. Um, so the valuation is good. I don't know if I'd call it an A plus, just because of the price book numbers, but it's certainly not expensive, I would say. And again, if you just want to go off of just chart theory, it's definitely at a trough. So I think the valuation looks really good too. Um, I think it looks good. Let's just look at the yield here. So this kind of gives you some insight into the variable nature of their yield. But I think it's very clear and fair to say when egg prices are howling and humming along, you're maybe feeling some pain at the grocery store, but these shares are paying double digit yields, right? But buying the shares when they're yielding that is not smart on a stock like this because they will inevitably drop. So, what are the risks? I mean, again, just kind of going into some recent news. This just came out within the last week. Cal-Maine makes a major diversification move by acquiring Van's frozen waffles business. It snapped up certain assets of the Van's food business of Sara Lee Frozen Bakery. So gluten-free waffles, significantly different than eggs. Addition of Vans is expected to increase the prepared foods annual sales by approximately 10% and volume by 6% on a pro forma basis. And then, management is saying we see meaningful opportunities to drive growth, unlock efficiency, and innovate ways that better serve our customers and consumers. So, yeah, that's all good and dandy. I think one thing that beside the lower egg prices, the market reaction to this has been very muted. You see that. I mean, this news happened. There was like a slight bump, about 5%, and then it hasn't really moved the stock much, as we see. And I think with a company like this, I think a lot of shareholders are probably holding it because they do want pure play egg exposure. And so when they see acquisitions like that, they're like, "Oh man, I really hope they don't go on an empire building spree and just start buying random food companies," because lots of businesses have done that and with mixed results. So I think what we see out of management here is that they're clearly making a push to diversify the business, and there's definite integration risks with that. So I think integration risk on this company, even though they have a very demonstrated track record of making successful acquisitions over time and having this like fortress balance sheet, yeah, there's always the risk that they continue to diversify their business and diversify and kind of lose the core engine of growth that makes them what they are. So, but you, I don't believe that you can readily and easily quantify integration risk in the short term very well. It's just something that you have to see through the results. So that's a risk. And then, of course, very simply put, If egg prices stay where they were over the last, pretty much throughout April, which you see there's been a slight uptick lately. If egg prices stay in the low, the company's not really going to make much money, and you're certainly not going to make any dividends until egg prices kind of pop again. So I wouldn't necessarily call that a risk, because that's just kind of inherent to you know being comfortable with the stock and these shares. But that's certainly a risk. I mean, it's very simply put, this is a cyclical business still, despite their continued acquisitions to diversify it, and you're just exposed to the egg cycle. So that's a risk that cuts both ways, and that's why people like that's why someone would want to own the stock in the first place. So um, because the valuation because the valuation looks good, like there's I think fairly meaningful downside protection there, just in terms of what we're doing. I find those risks to be fairly benign. But as always, it's you just got to know what you're doing with the cyclical stuff. So we see here, moving into technical analysis, this line isn't perfect, but given given the choppiness of the egg prices, we're not really in any sort of trend here. We continue to bounce kind of off this mid 70s level. The price hasn't gone below $70, or it hasn't been less than $70 since 2024. Um, we've got this, clear measure of support, and there's really no, clear and definite threshold of which it goes above, except for maybe here. But again, I would really urge my viewers to not overanalyze this from a technical perspective, and maybe care more about the technical aspects of the egg price instead. And I'm not going to dive into that here, but if we don't focus on the egg prices at all, we just look at this, I think that this chart is kind of a mixed bag, because again, where we're at here, this is our elevated egg prices. I mean, again, right here, egg prices from 2021 to 2023 were consistently higher than they are now. And we see that you could have bought these shares for less than $30, and they went up to $50, back down to 30 something, 40. And we're kind of in this heightened era here, and their financial results certainly lend credence to that, because again, this is kind of what I was drilling into here, where going back to 2023, September 2023, when egg prices were higher, we were making less money than we are now in revenue terms. So that's really constructive, and I think this chart does kind of make me a little nervous, just because there's if it breaks through this level, there's a long way to go before it finds any sort of support. I mean, the next support is like $50 probably, if you're just talking about the chart. So if you're just looking at the chart and you're not looking at the financials, I think there's a lot to not like about the chart. But if you kind of buy into the story that they've continued to grow revenues through operating leverage, through their scale, and through acquisitions outside of just the egg cycle, then I think that makes the way this look be more, less of a spooky chart and more of a really attractive looking chart. So yeah, I think that this chart looking the way it does kind of explains a lot of the fact that we've got a big short interest on the shares. 13% of the shares sold short, and so um, all it takes is for them to post really, really bad numbers. Oh, just gonna crap my back. All it takes is them to have a couple of dreadful reports and give shaky guidance, I think, for it to break down further. Um, but so far, the shares have held up pretty well in the face of the egg price decline. So I still think, given the risks of the egg cycle, the egg cycle doesn't fully appear to be priced in. It's priced in, but it's unclear if it's fully priced in like it was before. And I think that that's the market signaling a little bit more confidence just in the competency of the management and the track record of the company. So I think with all that being considered, for investors who are looking to kind of gain some interesting commodity exposure and like that variable dividend policy, I think it's worth taking a flyer on with a buy rating that I'll give it. Like, I'll give it a buy, but I certainly don't think, based on everything I'm seeing with the egg prices, the current stock price, and everything, that it's just like a crazy good opportunity here. But I think it's worth taking a flyer position. Again, I'm not recommending that you do that. I'm just saying, that's what I've done. I've started a small position in it about a month ago, and it right now is the smallest position in my entire portfolio. But I've been watching this company for a while. Always thought it was great. Never really bought in, because by the time I really, was seeing the story develop with the high egg prices, the price had already gotten away from me, and I knew that it wasn't a good time. Now we're at the most appealing entry point over definitely the last 2 years, I would say. I mean, obviously, if you bought here exactly 2 years ago, you'd be in the money on your shares. Obviously, when egg prices really started to move, that was the way. But again, this stock has been a compounder despite its cyclicality. And I think that that's worth something. I think that that's clearly the culture here and the management team that's been embedded in them. They manage their balance sheet very responsibly. And despite the valuation looking and being cheap, I do think that the market likes this stock a lot and assigns it somewhat of a premium. So that's a very cautious buy grade for me. Again, I think it's almost worth like a watcher position just to keep it on your radar if you find, based on your own research, that it's adequate for that. So that'll conclude our video today. Hopefully you found this interesting. I've certainly had a good time talking about it. I didn't really touch on everything. I didn't go into depth on their provided financials. There's a lot more analysis that can be done on all of these acquisitions, I think, just at a high level. Again, we don't have to drill down into super deeply on those for the purposes of what we're doing today. So that's going to conclude. Hopefully you found this interesting, and be sure to like and subscribe if you have found it compelling and good and entertaining. And give me some feedback in the comments. Let me know what else you might want to have me take a look at. And yeah, until next time, I'll be signing off. Thank you for watching, and I'll see you later. Bye.